Let's start away from the continent, however. Greece has become the first developed nation to be cut down to emerging market status by Morgan Stanley Capital International. Now, the country's stock index has dropped by 83% since 2007. And according to analysts, Greece has failed to meet the criteria on securities borrowing and lending facilities, short selling and transferability, hence the move by the MSCI, whose equity indices are tracked by investors with about $7 trillion in assets. And the company put Greece under review for downgrade in June last year, saying restrictions on in-kind transfers, off-exchange transactions, stock lending and short selling all stopped the country from having a fully functional securities market. Now, here in Africa, experts in Uganda's finance ministry say the country needs to raise domestic revenues in the next financial year in order to cover a gap created by budget support cuts from Western donors. Uganda's foreign aid inflows have been cut, with donors' contributions falling from 25% to 19% of the overall budget. Uganda, like three other countries in East Africa, will release its budget for the 2013-2014 fiscal year on Thursday, June 13th. CCTV's Isabel Nakiria has the details from Kampala.
It's Kampala's hub for metal fabricators, a slum at the heart of the capital. The work here relies on electricity. Fortunately for the workers, electricity generation is one of the priority areas that will receive the biggest chunk of Uganda's 2013-2014 financial budget, to be read on Thursday. But Hassan Waswa, a welder here, says electricity generation won't be of any use if unit costs stay high.
I'm begging the government to do.
What I'm begging government to do is to reduce the price of electricity, because many of us, electricity gives us what to do. Like here, we can't run anything without it.
In Uganda, electricity is the one.
In the next financial year, Uganda will have to adjust its budget so it does not rely so heavily on donor aid. This means increasing taxes on domestic revenues like electricity, water to telephone calls and even idle land. Another critical area that the government will tax heavily is the fuel sector, which has in the last financial year already seen a hike in prices. The country will have to operate on 19% from donors, down from 25% the previous year. This means utility costs for metal fabricators like Waswa, motorists and households will more than double. Dr. Fred Muhumuza, a financial advisor in the country's Ministry of Finance, says the government will have to reduce a number of expenditures like conferences and workshops, as well as foreign travels.
The donor cuts actually also affected the current budget that is closing. So the way we have managed through this year has also informed us in how we are going to manage in the coming budget. So in some cases, we have already, along the course of this financial year, reduced a number of expenditures which we felt were not very critical.
Uganda's central bank has recently revised the country's growth rate downwards due to aid cuts. It's estimated that growth will fall by 0.7% from the projected 4.3%. Financial advisor Muhumuza acknowledges the effects of the aid cut but says the government will improve efficiency in domestic revenue collections.
We shall also still have some of the donor programs still running. Not all of them were kind of cut off. There were a number of projects that were going on. Those will continue. But where we have critical investments that must take place, we may issue some domestic instruments to borrow domestically to finance those instruments. We are also intending to use some other alternative source of financing, like the public-private partnership financing.
Hundreds of millions of dollars of donor aid have been withheld following allegations that officials in the Prime Minister's office embezzled money meant for post-war rehabilitation in northern Uganda. The adjustments in next year's financial budget will be debated in Parliament before it's passed. Now, whether taxes on domestic revenues are increased or not, it's too early to tell until when Parliament decides otherwise. Isabel Nakiria, CCTV, Kampala.
It certainly does look off the back of that story that high taxes is a common theme as far as budgets are concerned. We'll have more coverage for that for you in depth right here tomorrow. Right now, though, in Kenya, operations at East Africa's only oil refinery were hit by a strike by workers at the Kenya Petroleum Refineries Limited. They blocked the entrance to the plant over reports that it could be shut down. This is the second protest in as many weeks at the facility, which is owned by India's Essar. It normally processes about 32,000 barrels of crude oil daily. That's about 4,500 or so tons. That figure, however, has declined by about 40% to 2,500 as Kenyan oil marketing firms buy less of the refinery's output. Kenya Petroleum Refineries Limited has a legal monopoly on oil refining under Kenyan law, and oil marketing firms are obliged to buy fuel from it. They just can't import refined material straight from the market. That said, OMCs say that the facility's inefficiency has unreasonably raised fuel prices to end consumers, causing losses estimated at $225 million per year. Now, given those losses, Kenyan oil marketing firms have threatened not to renew the merchant refinery agreement with KPRL when it expires on the 30th of June. On into West Africa, Ghana intends to renegotiate natural resource revenue contracts to boost domestic revenues and give its government what its vice president has described as fiscal space. Now, last month, the country's finance minister said he intends to bring in new levies and hike new taxes to raise additional revenues to cut the budget deficit this year. Economists, of course, were appalled when Ghana's budget deficit rose all the way to 12.7% of GDP this year. The vice president of the country has also said that there is room for a renegotiation of the country's entire mining law as a whole. Now, let's get some more insights into what's going on in the mining sector in Ghana. There's a summit taking place in the capital, Accra, and of course, we're keeping tabs on that. Right now, we're joined by CCTV's Miriam Bemart, is live in London. Miriam, with regard especially to Ghana, the cedi has strengthened by about 5% so far this year. What effect has that had on Ghana's attractiveness as a mining investment destination?
Well, Ghana is still a very lucrative mining hotspot for investors. Bear in mind, the price of metals like gold have been falling, and analysts say inflows from mining companies aren't coming in because the price of gold is weakening. So there's actually a need for more of a push to increase volumes in Ghana's mining sector. Now, experts say Ghana needs to renegotiate some resource contracts to increase tax revenues and give its resource-based industries like oil and precious metals more fiscal room to maneuver.
Indeed, but with respect to the other end of the equation, it's one thing to talk about the money, it's another thing entirely about spending it. The public wage bill in Ghana has gone up by 47%. Its budget deficit was twice the target last year. For investors on your end of the world, how big a concern is fiscal discipline?
You know, the experts that we spoke to say there was a growing expectation of higher taxes, for example, but many argue the government could have used a more gradual approach. You know, Ghana has been dealing with a ballooning public sector, as you were talking about, and there have been generous capital allowance schemes for mining firms for years. In fact, analysts say that tax breaks for investment make sense, but most were introduced about 30 years ago when Ghana was a far more difficult place to do business. Now, the bigger issue for investors is that Ghana has to monitor and keep in check its fiscal deficit that we've been talking about. After joining the Club of African Oil Exporters in 2010, some investors became quite worried with the fiscal deficit when it rose more than 12% of GDP, mainly affected by the public sector salary costs that we're seeing. So really what they want to see is that the government steps up and monitors this.
Miriam, finally, question to you. The Ghanaian Vice President, of course, spoke about a complete revision on renegotiation of some resource contracts. Will investors on your end of the world be watching the Ghana Mining Summit very carefully for any information on mining code reforms from other African countries as well?
Definitely, Rama. You know, it's a hot topic for foreign investors with the corporate tax increases we've been seeing in the last few years in Ghana and Zimbabwe, just to name a few places. You know, investors have been hit hard. Of course, we've seen all the political unrest as well. You know, many experts say that mining codes remain difficult to understand with a need for a more uniform system in place. You know, mining regulations are aimed to maximize revenue from the sector and help service the engine of growth and development. The problem is that many see the current mining codes as a way for governments to nationalize resources without providing benefits to either side, both the investors or the public.
Indeed. We'll have to leave it there for the time being. Thank you very much for your insights. That's CCTV's Miriam Bemart live for us there in London. We'll be keeping tabs on the Ghana Mining Summit right here as the event continues. We take a short break on Africa Live. Here's what's coming up next. In South Africa, the World Bank is calling for better access to financial services in order to tackle unemployment. We'll be exploring that interesting notion when we return.
BizAsia. Asia means business.
Welcome back. The World Bank has called on South Africa to improve the levels of financial inclusion. Now, given the fact that this country has the highest number of bank accounts per capita among adults in Africa, that recommendation at face value seems quite odd. But as CCTV's Sumitra Naidu reports, it really isn't.
Despite government efforts, South Africa is still struggling with rising unemployment. The World Bank has lowered its growth forecast for South Africa, citing a weak economy, labour strife and its exposure to volatile international markets. The bank is proposing some action in areas like financial services, where access to these services needs to be improved. Over 12 million South Africans remain unbanked.
Financial services provide room to diversify risk. So if you're just an individual who doesn't have any relationship to the formal financial sector, no savings, which is the usual product that individuals use first, then if something happens to you, you get sick, you don't get any more work, you're obviously in a much more difficult situation than if you had a cushion of some sort to rely upon.
While South Africa boasts a fairly sophisticated financial services sector, it has not sufficiently catered for the poorer income groups. High bank charges have prevented many from getting a bank account. Of those who do have a bank account, less than 20% use it more than 3 times a month, which means it's just an instrument for receiving income.
Financial inclusion is one instrument of broadening economic inclusion, and it's an important instrument, as the World Bank research has shown, for not only South Africa but other countries as well, including mobile technology, is already there in South Africa to a greater extent than it is in other developing countries. That's an advantage, and maybe that advantage is not being utilized to the full extent.
Larger banks are not that conversant with the small enterprise sector. They have experimented in this area. It's not because the large banks have not tried, they just haven't succeeded in their experiments. And that probably means that another kind of institutional structure would be to the benefit of the small enterprise credit environment, if you like.
South Africa's existing infrastructure does have the potential to reach out to large sectors of the population. There have been moves towards mobile and retail banking, which are more cost-effective ways of providing access to poorer and rural communities. According to the World Bank, South Africa has the highest share of adults with a bank account compared to any other African or BRIC country. But this hugely masks the income inequality divide between the rich and the poor, men and women, rural and urban residents in the country. For South Africa to strengthen its economy, it needs to increase the financial empowerment and education of its people. And the first step in financial inclusion is having a bank account. Sumitra Naidu, CCTV, Johannesburg.
Let's get some more data for you now. CCTV Sumitra Naidu is live in Johannesburg tonight. She joins us live from that city. Sumitra, the rand dropping under the 10 rand to the dollar mark today. What drove that trend?
Well, it's been a crazy few weeks here in Johannesburg, in South Africa. Just looking at the way the rand has swung from side to side, the market volatility has just been really high. And of course, today we saw the rand coming all the way back below that key 10 rand mark. Yesterday we saw it pushing all the way to 10 rand 38. Of course, you know, it was a little bit oversold. Market traders said that it needed a bit of a correction today. But I think the key factor coming through today that really lifted sentiment in the rand was the comments coming through from President Jacob Zuma. He was speaking in Parliament today, and for the first time, he really took a hard line in terms of what's happening in the mining sector with the labor unrest. And for the first time, it actually showed he showed a bit of resolve in actually sorting out the problems in this mining sector. Of course, it's been going on for quite some time, and investors are seeing that as a move in the right direction. So some of those comments included a warning really to labor in this country, saying that no labor unrest will be tolerated. You know, it it shouldn't be used as a means to get to mining companies. And he said that, you know, all authorities have been put on high alert and they will not tolerate any disobedience coming from the sector. So really tough words coming through from the president today. And a lot of traders and analysts seem to think that that was really what investors wanted to hear.
Right, a swing in sentiment then. Let's talk about the mining sector in a little more detail. AMCU was ideally supposed to hand over a strike notice to Lonmin management sometime today if they did not reach an agreement on recognition of majority status. Did that happen?
Well, that threat remains. AMCU is threatening that it will go ahead with its strike action. Lonmin, on the other hand, is saying that if it receives any notice, it will go to the court and seek an urgent interdict to stop the strike action. But we just heard a short while ago that both parties are still in negotiations. And I heard Lonmin just a short while ago saying that it's hopeful that some sort of agreement will be reached so that all of this action can actually be avoided. So we're waiting for that. So for now, there's no pending strike action if some sort of deal comes out of this meeting this evening.
Finally, let's pull back a bit and look at the mining sector around the world. A report by Ernst & Young out today pointed out that access to capital and its allocation is a top risk element that mining companies around the world are looking at. Is that really the case as well in South Africa?
Oh, absolutely. And, you know, we have seen it in recent months. We saw quite a few mining companies last year already coming through and saying that the situation is extremely tough and they would not be feasible to continue running. A lot of the platinum mines also put some of their shafts on care and maintenance. And it's really what Ernst & Young is saying. It's this risk in actually raising the capital to run these big mining operations. In South Africa, you know, adding to that, we have high energy costs, we have high labor costs. So adding to all of that and raising this capital, you know, mining is becoming more intensive in this country. Miners have to go much deeper than they were previously. There's huge security concerns. So with that brings an added risk. And of course, you know, it's weighing very heavily on the mining companies here. We're seeing, you know, big companies like Anglo American also announcing that it would need to put some of its shafts on care and maintenance because it's just not economically feasible to continue running those mines at this stage.
Indeed. We'll have to leave you there for the time being. Thank you very much for the update. That's CCTV's Sumitra Naidu live in Johannesburg for us tonight. Now, while the global airline industry showed a $12.7 billion profit overall and a 4.8% return on investment, capital returns are way below the 7 to 8% average cost of capital required for the industry to buy new planes. Now, these are some of the key issues that were being discussed at a recent IATA conference in Cape Town. CCTV's Angelo Coppola was there.
If airlines are to find the $4 trillion to $5 trillion needed to finance projected fleet developments over the next 20 years, something will have to change in the sector. It's a bit of a mixed bag with demand for new planes at an all-time high in Africa, but it's not all good news.
Us corporate jet side, people are tending to take a wait-and-see attitude. Just like you or I might put off buying a new car for a year or two if times were uncertain.
For any manufacturer to have a sustainable presence on the continent, it's imperative that they develop a local maintenance and repair capacity and provide training within the local community. One manufacturer has a well-established partnership in Southern Africa.
We recently opened a factory in Morocco. Okay, we have it's in a suburb of Casablanca, and we're expanding that factory there. Of course, with the more expansion, more presence, more facilities. And our North African customers, they already have now good support themselves internally. We have helped them develop their own maintenance capabilities, and we will continue to do that.
In terms of the big issue facing two of the big three international manufacturers, it's not about finding customers. According to these manufacturers, there is no shortage of demand.
My biggest issue is to conclude deals, be able to deliver, give our customers the delivery positions that they want, and of course work with them on finding the financing solutions for these. Some of these customers are easily financeable, some others are not so easy financeable.
While finance remains a key challenge for local operators, perhaps the biggest consideration is fuel efficiency. Each manufacturer has approached this challenge slightly differently. One is working and focused on power unit developments, while another has lightened the weight of some of its aircraft.
Fuel today is about 40 to 50% of an airline's operating costs. And with the A320 Neo family, new engine option family, we can offer savings of about 15%, which is a big deal for the airlines.
The new African reality is that manufacturers have turned their attention to the continent as sales opportunities remain elusive in the rest of the world. One manufacturer has quadrupled their sales and marketing team on the continent. The biggest factor facing African operators, other than securing favorable finance, is the cost of fuel. Perhaps it's time for a regional fuel supplier. I'm Angelo Coppola for CCTV in Cape Town.
Quick run through the markets for you now. Flood of red ink, I'm afraid, especially as far as some key markets on the continent are concerned. Let's start in Nigeria. The all-share index closing the day 2.75% lower. The all-share index in South Africa, after yesterday's losses, paring back some of those gains, closing its way back up by just over 0.2. The 20-share index in Nairobi, quite a bit of profit taking on this particular market, ending the day half a percentage point lower. In the Egyptian market, the EGX down by a massive 1.17 percentage points. That's it for business today.